Hello, everybody. This is Hugh Johnson, and welcome back to My Market Minute. So I give you a little bit of an update on what our thinking is at Hugh Johnson Advisors with regard to not only the financial markets but the economy. And I guess now these days we've got to talk a little bit about politics as well. The big question, of course, that everybody asks is, look, Hugh, this has been a very long bull market and a very long economic recovery, really comparatively speaking. It's been either the second or the third, depending on what you look at, the second or third longest in the post-war period. And therefore, the question is, are we near the end of the current cycle? Should we be taking steps to become a little bit defensive? Should we reduce our allocation to equities in order to be defensive and to do that very, very important thing, which is preserve capital in the event there is a bear market and a recovery? I only say this is that I can understand, certainly understand your concerns. One thing that I say to everybody is, what's important is to be able to sleep at night. And if the current allocation to equities that you have is a little bit high, that makes you feel uncomfortable, you feel you believe you'd feel a little bit more comfortable if you reduced your allocation, say, from 65% down to 55%, then by all means, you certainly should do that. And we'll operate with whatever target you set for equities. And again, I couldn't emphasize more strongly how important it is to sleep at night. Beyond that, when it comes to our own view and how we're managing portfolios, regardless of what your target is, we're going to manage portfolios using the kind of disciplines that have helped us so much in the past, certainly helped us in 2007 and 2008 in reducing our exposure to equities and preserving capital during that very difficult period in 2008. And right now, when we look at the performance of the financial markets, which is so important to telling us where we are in the current cycle, when we look at the performance of important economic numbers, economic variables like the index of leading economic indicators, the answer to the question is, should we reduce? The question being, should we reduce our exposure to equities? Are we near the end of the current stock market business interest rate cycle? The answer that we would give is based on those numbers that we don't think we're certainly not at. We may be near, but we're certainly not at the end of the cycle. So we'd continue to at least for the time being, maintain a meaningful allocation to equities. That equities are going to be the best performing asset class. They're going to be outperforming fixed income securities. Obviously, we could be wrong. It's always possible in this very tricky, very volatile financial market environment to be wrong, but nevertheless, the disciplines that we are using and refining all the time. Got a lot of people that we've hired recently that are pretty good at quantitative analysis that are helping us refine our ability to try to identify whether the current cycle is alive and well or not. But given all that we're looking at right now, it says we should continue to maintain a meaningful allocation to equities and continue to watch very closely. When you're this far into a cycle, you need to watch very, very carefully. There's a couple of things right now that worry us. I'm always worried, as you know, about valuation. Stock market might be a little bit pricey or overvalued. It's come very far, very fast since the election. At the same time, I can still make the case for higher stock prices. I can make the case on the basis of assuming a big assumption, and probably not a good assumption, that some of the corporate tax cuts that the Trump administration has on the table, a reduction in corporate taxes from 35% down to 15%. That's not going to happen. Maybe 35% down to 25%. That even is somewhat perhaps of a long shot. If that occurs, that's going to be a big help, or a big help to corporate profits. And if we get higher corporate profits, then we can justify or make the case for higher stock prices. The other thing is the consensus forecast for earnings, both for 2017 and 2018, is pretty solid, pretty strong. I think that that consensus forecast, is probably too high. Historically, it has been by about 7%, but even when I bring it down by about 7%, I can probably make the case for modestly higher stock prices. So modestly higher stock prices, or a modest continuation of the current bull market, and we'll have to see how earnings play out over the course of 2017, 2018. Believe me, With all the politics that's going on in Washington, with all the attention that's being given to politics going on in Europe in general, but of course the United Kingdom in particular, with all that's going on politically around the world, still the most important thing for the financial markets here, the equity markets, is going to be earnings. And we really have to keep a close eye on trying to measure how they're going to play out. That right now looks like a positive economic environment for 2017 and 2018, even though growth won't be strong. A positive view or outlook for earnings, so even though I don't think earnings are going to be as strong as the consensus expects, and therefore I can make the case for stock prices moving a little bit higher. And obviously, in addition to that, that's the valuation concern. Going to watch very carefully for those signs that tell us from the financial markets or the economic numbers that the current cycle is about to end. Right now, everything looks fine right now. But believe me, when you talk about people that are generally, by nature, extremely cautious, extremely careful, that recognize how important it is for us to be very good on this cycle, to preserve capital when times get difficult. Believe me, we know how important that is, and we're going to spend a lot of time, energy, and resources in getting that as right as we possibly can, recognizing that it's very easy in this business, as we all know, to be wrong. Over a longer period of time, equities are going to perform great. They're going to outperform fixed income securities, and we're going to be fine. Thankfully, when we do hit the end of the cycle, bear markets and recessions are generally short by nature. They're only about 14 months. The average duration of a bull market and a recovery is 57 months, and sometimes they last significantly longer than that. So bull markets and recoveries tend to be much longer than bear markets and recessions, and that's very good news. So even if we do hit the end of this cycle, in my judgment, and based on history, it's not going to be that long, and it's not going to be totally disruptive to our plans of really doing well for you over long periods of time. So once again, bringing you up to date on where our thinking is now. Still positive, still cautious, still watching very carefully. Really appreciate, as always, all the confidence you show in myself, the rest of us here at Hugh Johnson Advisors, the entire staff, and really welcome you, as always, to give us a call, tell us what your concerns are, talk about your portfolios, basically to call us anytime you want. We really do look forward to talking to you, and thanks very much for your confidence, ongoing confidence. We're still working real hard to deserve it or to earn it.